Good morning. This is Dave Toth with an RJO MRT Technical Webcast update on the equity indices and the energy complex for Monday, August 30th. Starting off here with an intraday chart of the September S&P contract, you can see that by virtue of the market's recovery late Friday and overnight above this 1062 to 1066 range that we have defined as the latest and tightest former support and new resistance and risk parameter to a bearish policy, the market's recovery above that range has interrupted that bearish policy and defined last week's 1037 low as one of developing importance. And because of that, we are advising traders to move to a neutral sideline position from a previous bearish position in order to circumvent the heights unknown of an interim corrective process. For within the context of the daily log scale chart here, and on the heels of July's three-wave 61.8% recovery that we believe to be a major bear market correction, we believe that this short-term strength over the past few days exposes just an interim corrective hiccup ahead of a resumption of the April-July sell-off to eventual new lows below 1002. On this grander scale, strength above the 1128 high from early August remains required to negate or mitigate this broader bearish count and expose a larger reversal higher. In lieu of such strength, we advise traders to approach interim recovery attempts, as we're experiencing right now, as corrective selling opportunities. But again, by virtue of the strength above 1062 to 1066 range, that confirms the short-term trend is down. The short-term trend is up. We simply don't know the extent of this intra-range recovery as a selling opportunity. So a neutral sideline position is advised for the time being. We'll look for a bearish divergence in short-term momentum to reject and define a more objective high and risk parameter from which to reconsider bearish exposure. Similarly, in a September Russell contract, the market has recovered overnight above the 61.79 corrective high from August 23rd. That confirms not only the short-term trend is up and a bullish divergence in short-term momentum, but it exposes that 58.64 low from August 24th as we believe the end of a complete five-wave Elliott wave sequence that is now prone to a corrective recovery. Within the context of a longer-term bearish count, however, following a three-wave July recovery, 50% recovery, that we believe is part of a broader bearish move. You can see the market's recovery from the extreme lower recesses of the past few months' range. That, combined with that five-wave Elliott wave sequence down in short-term bullish divergence and momentum, we believe exposes an intra-range but corrective recovery that we feel will ultimately provide a favorable risk-reward selling opportunity for a resumption, an eventual resumption of that April-July slide. On a longer-term scale, strength above the 66.32 high daily close from July 26th remains required to negate this broader bearish count. Until or unless the market confirms a bearish divergence in short-term momentum, in absolute fact, the very short-term trend is up, and weakness below Friday's 69.40 low is required to render this recovery attempt a three-wave corrective sequence that we suspect it is, but until we get proof of that resumed weakness via either a relapse below 59.40 or a bearish divergence in short-term momentum to arrest this current short-term recovery, the market is exposed to further intra-range gains, and we advise a neutral sideline position because we simply don't know how much this market might be able to recover. We can designate 50 and 61.8% retraces at 62.90 and 63.90, but we never rely on such derived relationships without accompanying momentum failure. So in sum, we are respectful of this intra-range short-term recovery and uptrend, but we advise traders to view it as a corrective selling opportunity, and the moment we get a bearish divergence in momentum and or a relapse below 59.40, we'll advise accordingly again on the bear side. Moving to the energy complex, and given its very positive correlation for a number of months now to the equity indices, you can see a similar recovery in the October crude oil market with Friday's gains above the previous intra-week high at 73.98, and certainly a confirmation of a bullish divergence in momentum above the 74.48 corrective high that we have had as a risk parameter. We believe the market has defined the 70.76 low from last week as the end of a five-wave Elliott wave sequence down that is now prone to a correction higher. You see that thus far, overnight's high at 75.58 is exactly the 38.2% retrace of this entire 83.40 to 70.76 slide, but you can still see clearly that at least the short-term trend is up, with weakness below Friday's 72.04 corrective low now required to arrest this recovery attempt and expose it as a three-wave bear market correction. We suspect it is, but as long as the market sustains above at least 72.04, in absolute fact, the short-term trend is up, and it should not surprise by its continuance. However, taking a step back to consider the long-term daily chart, and again, we still believe that the entire May through July recovery or early August recovery attempt is a major three-wave and thus bear market corrective sequence that ultimately will expose new lows below the May 25th low at 67.15. And in that regard, we advise traders to approach this recovery attempt as an eventual favorable risk-reward selling opportunity. But as long as the short-term trend is up, we want to act on the premise that we don't know how much this market might correct higher. So a neutral to sideline position is advised for the time being, with weakness below 72.04 required to re-expose this broader slide. And in lieu of such weakness, further gains are anticipated, and we'll be watchful for any bearish divergence in short-term momentum needed to stem this recovery attempt, and then define a more objective high and risk parameter from which to reconsider a bearish play. Similar price action is shown here in the October RBOB contract, with the market on Friday taking out the 188.20 corrective high from Monday that jeopardized the impulsive integrity of this broader slide. It confirms at least the short-term trend as up and defines Friday's 184.50 low as the level now, the tightest level this market needs to fail below to render this recovery attempt a three-wave and thus bear market corrective recovery we suspect it is. From a very long-term perspective, and just like with the crude oil market, strength above the early August high at 219.93 remains required to stem a long-term downtrend. And define the recent low at 178.49 as perhaps the end of a major bull market correction. The market's quite a long ways away from that 219 handle, and in fact, looking at a daily log scale close-only chart, you can see former support from the 192 handle area now as a significant resistance candidate. So we want to be particularly watchful for any bearish divergence in short-term momentum, like a failure below 184.50, that would re-expose the broader slide. In sum, a neutral to cautiously bullish policy is okay in the RBOB contract, with weakness below 184.50, stemming this recovery attempt, defining it as a corrective recovery ahead of an eventual resumption of not just the August slide, but the broader slide dating all the way back to that May 3rd high at 244.11. And lastly, looking at the October heating oil market. Earlier in the week, the market had confirmed a bullish divergence in momentum above the 201, the figure area, that confirmed at least the short-term trend is up. And also by virtue of Thursday's and Friday's setback attempt and then the recovery from that, the market has defined Friday's 199.94 low as the latest and tightest corrective low the market is now required to fail below to arrest this recovery attempt, expose it as a three-wave and thus bear market corrective sequence we suspect it is. In lieu of weakness below at least 199.94, further gains are anticipated. But again, like with the rest of the energy complex, the August sell-off coming on the heels of a clear three-wave sequence from the May lows to the early August highs, we are viewing as a major bear market correction, resuming the initial slide from the early May high at 235 down to 184.83. We believe this August sell-off is a resumption of that May slide, and this current recovery attempt, intra-range recovery attempt, is a corrective recovery attempt and eventual favorable risk-reward selling opportunity. In sum, however, in the short-term trend clearly is up, and until the market either confirms a bearish divergence in momentum or fails below 199.94, we anticipate further intra-range gains. But we again want to act on the premise that this is a broader bear market correction, and want to be particularly careful about not overestimating the extent to which this market might recover. Please stay tuned to updates on these and other markets on our rjomrt.com website, and good luck with today's trading.